Hello and welcome. My name is Michael Ingworth from Family Retreats UK. Now today we're going to be talking about being tax efficient in property in the area of capital gains and inheritance tax. In my previous two videos I talked about what is good debt and what is bad debt, and we talked about income tax. If you haven't seen them, I'd advise you pause the video now, go back and watch them, and then come back and watch this one. Again, I'm trying to condense these videos into bite-sized chunks so they don't take up too much of your time. Just as a reminder, there are three main taxes when it comes to property. First one is income tax, capital gains tax and inheritance tax. There are two fundamental rules to remember when being tax efficient in property. The first one is never ever sell your investment properties. Never sell them. You need to make sure they're the right properties, and if you follow our deal analyzer, they will be. The second rule is, as the property goes up in value, you increase the debt against it. I'll explain more about that later on in the video. So what we're going to do here in this example is we're going to buy a house for £100,000. Okay, and then we know in the UK on average it will double in 10 years, but to be conservative we're going to say double in 15 years. So we start off at £100,000, so the first 15 years it's going to be valued at 200,000, and then the next 15 years it's going to be valued at 400,000. So let's go back to our two guys, Nick and Dave. Now let's roll reverse, because Dave was pretty hard done to last time, wasn't he? So Nick now is going to decide to sell his house after 30 years. Okay, so he's the government's going to come to him and say, okay, see, you've sold your house, you've now got some capital gains tax to pay. So you're a 40% taxpayer, so 28% tax, you're going to have to pay around about £84,000. Okay, so, oh, by the way, if you're a 20% taxpayer, it's still going to be around about £54,000 tax bill. So Nick sells his house for £400,000. So after he's paid the estate agent and he's paid his tax bill, he's left with around about £300,000 in the bank. So let's take a look at what Dave's going to do. Now, Dave remembers his conversation, his teachings from Mark, and he says, I'm never going to sell my property. What I'm going to do instead is I'm going to refinance it. Okay, so he refinances it with 75% mortgage. So on the property worth 400,000, he's going to end up with about £300,000, as Nick did, in the bank. Okay. But what is the difference between Nick's £300,000 and Dave's £300,000? Yeah, the difference, huge difference, is Dave still has his property. Nick sold it, so he's not going to earn any more money out of that property ever again. So what's going to happen? And this is not a trick question. Okay, Dave still has his house, so in the next 15 years he's going to do the same thing again. He's going to refinance it, or refinance it through those years, and his portfolio now, his property is going to be worth £800,000, and then the next 15 years it's going to be what? It's going to be £1.6 million. I think Nick's feeling a little bit upset at this point in time, or certainly his children will be upset at this time. So the moral to this is never ever sell your investment property. So this leads nicely on to the next tax, the inheritance tax. Okay, so when someone passes away, the first £325,000 will be tax free, and if it's a couple, the second person dying, the amount will be £650,000 tax free. Okay, so let's make this simple. Let's just say the residential home and any equity left within it, and any other stuff within the estate, that the family allowance, that will cover the family allowance. Okay, just so we're comparing apples with apples. Okay, so let's just go to example one, where Dave, Dave has paid off all his mortgages. All right, so there's nothing to pay. and he's probably paid a lot of income tax in the process. So what happens to Dave? Okay, so Dave ends up with, you can see here, £1 million portfolio with no debt. Okay, and then the government come along and say, right, you've got 40% tax to pay, which is about £400,000, and you'll need to pay this in the next 12 months, roughly. Now, unless Dave's a genius, he couldn't predict when he was going to die, so he could have died when we're in a flat market or a declining market. So now suddenly the family's left with a distressed sale because they've got 12 months to pay this tax. So that's now someone like me will come along and say to the family, look, I can give you a quick sale, but I want 20% discount for a quick sale, which will probably end up having to do because of the distress situation. Now, poor Dave, who's worked all his life building his portfolio to leave a decent estate legacy for his kids, he's probably going to end up only leaving about half the original value. So let's look at Nick in example 2. Okay, so again, he's the same £1 million portfolio. Now he's got £750,000 of debt on it, but remember, it's good debt. Okay, he's not paying for it; someone else is paying for it, and he's been getting profit on top of that. Okay, so again, the government come along and say to his kids, Nick's kids, okay, 40% tax. Your tax that's just going to be on the £250,000 equity that's left. So his tax bill is going to be £100,000 compared to Dave's. I know which tax bill I would like to get, and actually we can get that down to £10,000, but that's in another video. So thank you for watching. I have one last video in this series, saving the best till last, and this is about how do professionals take their profits tax efficiently. Okay, that's a good thing to know about that, isn't it? Eh? So look out for this video, or again, if you can't wait, you can hop on my YouTube channel, link down here below, and watch it now. So grow your knowledge, build confidence, invest, and grow your financial freedom. Thank you. Speak to you soon.